Hi everyone and welcome to Before Consensus. Thank you very much for all your comments after the previous video. Many of you were drawing a parallel between 2018 and now. When I zoom in the S&P 500 chart, I can see that in 2018 we barely retested the bull market support band, the 55 exponential moving average. So what I was saying in the comments is that in my opinion, there's a better parallel with 2019, 2020 than with 2018. So today we're going to explore that idea. Let's look at what the Fed was doing, the US Federal Reserve, what it was doing back then in 2019. So to do that, let's look at the Fed's balance sheet and let's also look at interest rates. So if we look at this from that perspective, we can see that the Fed ended QT, or quantitative tightening, in September 2019 and started injecting money in the system. And at the same time, interest rates were coming down. They stayed flat for some time until the systemic shock happened, which at that point was the COVID-19 pandemic that sent liquidity skyrocketing and interest rate down. So if we compare that to the current setup, we can see that in December 2025, the Fed also ended QT and started injecting money by buying short-term treasury securities, and interest rates were also coming down and are flat as of now. So the question will be, thinking about that a correction is coming as per the previous video, what will be the systemic shock that sends liquidity skyrocketing and interest rates down? Sometimes to look at what is next in the equity market, it is good to look at the credit market. And right now, we are getting a very clear signal from the credit market. So if we look at HYG, the high yield corporate bond, we can see that has just confirmed a technical breakdown. If you see last time that credit went down was from February until the end of March correction. Before that, we can also see there was a breakdown between March and Liberation Day. And we can also go back to the time that we are drawing the parallel, the pandemic, and we can see the massive breakdown in credit between February and March 2020. So these are more indicators that are pointing as well towards a correction. Thank you very much for listening. Please do share your comments and I look forward to replying to them in the next video.